You've been pitching for 6 months. You've skipped vacation, maxed out your credit cards, and rewritten your deck more times than you can count. Finally, the big meeting. The one investor who could change everything. You finish your pitch, silence. They smile politely, thank you for coming in, and you walk out with nothing but the sound of the door closing behind you. What went wrong? Today, we're breaking down the 5 biggest mistakes founders make when raising money. The silent killers that can burn your opportunity before you even see it coming. And if you stick around to the end, I'll share a bonus mistake that is incredibly common and most easily avoided. I've sat on both sides of the table hundreds of times as an investor and as a founder. I've seen incredible companies get funded in days and great ideas die on the table because of these exact mistakes. If you're raising now or planning to, you need to know these because one wrong move can cost you the deal, your credibility, and even your startup. The first mistake? Raising the wrong amount. Sounds simple, but it's one of the most common and costly errors. Ask for too little and you're back asking for more capital or trying to find more investors 6 months later, forcing you back into the market looking desperate. Founders, especially first-time founders, almost always underestimate how fast they'll spend the cash while simultaneously underestimating the time it will take to generate meaningful revenue. Those two factors create a financial squeeze that can end companies. Meanwhile, raise too much, and you either give away far more equity than you should, or you make your next raise that much harder. And that's assuming you can even justify the number. The goal? Raise for at least 18 to 24 months of runway and turn into Scrooge McDuck when it comes to spending that capital. Remember, startups have to go farther on less money than ever. The average time between a seed stage round and a Series A in 2025? 4 years. You need a runway long enough to hit meaningful milestones, but not so much that you're taking unnecessary dilution or subjecting yourself to investor pressure. We had a founder raise a $1 million pre-seed round and 7 months later was flat broke with almost nothing to show for that bonfire of cash they burned. In this case, they raised too little and didn't seem to care at all about capital efficiency. Either of which could end their startup and in this case was guilty of both. The second mistake? Locking in terms that make your next round almost impossible. This mistake can sneak up on founders. One of the challenges with raising money is that once you raise money from venture capital investors, you usually operate a business model focused on growth, and that will require multiple rounds of investment. Many times, founders don't think about how their current fundraise will affect their next round. We once passed on a deal where the founder, whose company didn't even have a finished product and zero revenue, wanted a $10 million valuation cap on a convertible note. It sounds smart, right? They were protecting their equity. But what you're really doing is setting the bar so high that your next raise may be impossible. Within a couple of years, that same company would want to raise a bigger round. Their benchmark is now $10 million. Pretty hard to accelerate your valuation to $20 million or $30 million to fight off dilution, now made inevitable by that pre-seed valuation. Unfortunately, that company stuck to their guns. And after striking out with institutional investors, raised some money from a gaggle of angels at that $10 million valuation cap they wanted. 3 years after, they struggled through a handful of smaller down rounds and from what I can tell are fighting to stay afloat. The third mistake is wasting your time and your shot on the wrong investors. I've seen founders burn time and effort pitching to people who don't invest in their stage, their industry, or even their geography. It's not just a numbers game, but in fundraising, bad shots don't just miss. They waste time and social capital. I get it. Too many VC shops have an obnoxiously pretentious website that only has their logo on an otherwise blank landing page. It's hard to know who to talk to. In my experience, the most successful founders heavily lean on their networks to get introductions to investors who make the most sense. The other option is to Google the managing partners for their interviews, social posts, or other clues about what they're investing in. VCs like talking about themselves and what they do a lot. They carelessly drop hints and clues if you look for them. Bonus tip, reach out to founders they've backed and ask them for any insight about that firm, their thesis, and if you're particularly charming, you could get an introduction. I've had dozens of founder introductions from our existing portfolio companies. And unlike that cold email from the startup trying to put a nuclear reactor on the moon, I always take the meeting from a founder intro. Before you send a cold email, research investor fit, stage, sector, check size, geography. If they've never written a check in your lane, you're probably wasting your time. Mistake number 4 is double trouble, weak decks and weak preparation. Your pitch deck is your story, and if you're not putting your best effort forward, that story may end up a Greek tragedy. I'm a big fan of the 10-20-30 rule. That means 10 slides total that take no more than 20 minutes to present, and the text is in 30 font or bigger. The goal here is to convey why this, why us, why now, and why should I care for investors in the most compelling way possible. If it doesn't clearly answer those core questions, you might as well be pitching in Latin. Remember, you're competing with hundreds of other pitches. If yours doesn't force investors to pay attention, they won't, and they'll just move on to the next deck. The best deck I've ever personally reviewed was 5 slides long. And let's not forget, Stripe raised $10 million on a deck that was 10 slides long. $1 million per slide is a pretty good ratio. And it's not just the deck. If you don't have your legal, financial, and business docs ready, you're dead in the water. I've seen founders get an investor excited, get asked for a data room, and then ghost that investor for 2 weeks while they scramble to put a random set of outdated spreadsheets and reports into a shared drive. Just like in sales, time kills deals, and not having due diligence materials really is an own goal. You'll still get very specific questions and requests for info that isn't in your data room, but having a basic data room set up signals you're serious, prepared, and ready to execute. And the 5th mistake? Ignoring the fine print or attempting to practice law without a license. Accepting unfavorable terms like excessive dilution, onerous warrants, or clauses that give investors too much control over key decisions can cripple you later. And most investments come with information rights, major investor rights, and other compliance requirements. If you just thought, what the hell are information rights, or have no idea what a warrant is, hire a competent lawyer, not the family friend that once got your dad out of a speeding ticket. The language and structure is super specific to private investment, so hire a lawyer who knows this stuff and can explain it to you. I know lawyers aren't cheap, and I hate paying those invoices too. But this is too important to rely on some chat GPT prompts to decipher the language, requirements, and potentially consequences. We had to call in a penalty on a note we held for a startup we invested in because they were out of compliance on a major covenant. That penalty called for an admittedly obnoxious grant of additional equity to us as investors. The founder was shocked it was a condition of our investment, despite having signed off on the closing documents that contained clear language about this penalty. Before you assume we were the jerks in this story, the founder ran the company into the dirt and left a bunch of employees waiting for weeks of back pay. So the extra equity grant we claimed is effectively worthless, and to date, I don't think those employees have been paid, which is awful. Just remember, investors typically stay on your cap table for 7 to 10 years. That's a long time to partner with someone that handed you a bad deal. And in my experience, if they've done it once, they'll try to do it again. So here's the bonus mistake I teased at the beginning. Most founders don't work hard enough to raise meaningful investment. Sound harsh? Maybe, but when a founder starts to fundraise, it becomes a second full-time job. Countless times I've heard from startups who are complaining their fundraise isn't going well or it's taking too long, only to find out they've only talked to 10 investors over a 3-week period and are irritated they haven't gotten a term sheet. You need to be prepared to talk to dozens of investors over many months. You need to be willing to commit the energy and focus required to land that investment. It will be frustrating, confusing, and even humbling. But that's just how it works. There aren't any shortcuts here. I know we've all heard about that one founder who got a $10 million investment from the very first investor they talked to. And if that happens to you, fantastic. But you need to prepare for a long, soul-sucking process. Fundraising is high stakes, and these mistakes are avoidable. Know how much you need and why. Negotiate terms that help your future rounds. Pitch to the right people. Nail your deck. Prepare your docs. And never sign something you don't fully understand. That's it for this episode. Like, comment, and subscribe. We'll see you next time.